Please welcome Principles of Hotel Development.
All right. Good morning. Good morning. Good morning. Really excited to be here. As the previous gentleman said, thanks to Hunter, and really excited to learn where the coffee is. I haven't even tried to find it yet. So yeah, excited to be in the space. So we're going to get started. Principles of hotel investments. We could actually spend, 4 weeks, 5 weeks? Clay, how long is your class? A semester?
Yeah.
We've got 60 minutes, so we're going to move fast. We are going to have time to stop for questions, so be thinking of that. But first, we're going to start with introductions. Jenna, I'm going to start with you.
Sure. Hi, good morning. I'm Jenna Pandagopoulos. I'm the Vice President of Development for North America for Minor Hotels.
Thank you. Sam?
Samantha Ahuja. I am chair of the Global Hospitality Group at Greenberg Charig.
Good morning. My name is Clay Dickinson, and I am a professor of hospitality real estate at Florida International University.
And I'm Rick Pastorino with RevPAR International, a hospitality advisory and asset management firm based out of Washington, D.C.
Perfect. And I'm Andrea Belfanti, the CEO of the International Society of Hospitality Consultants. So we are going to start pop quiz, and there's some bright lights, so you're going to have to raise your hand. How many of you think the total number of global hotel rooms is 10.5 million? No? 17.5? 29.2. All right, I got a few. Okay, we're going to try this again. Good morning. Okay, 10.5. Raise your hands. Nobody. Okay, 17.5. Nobody? Oh, wait. Okay, I got one here. Thank you, Heather. All right, 29.2. We got a few in the back. The answer is 17.5. Good job, Heather Carnes. All right, so.
Does she win a prize?
I know, I have no prize. I'll give you a hug later, yeah. So you can see here kind of how the number of hotel rooms globally has increased over the years. You can see why we have this amazing conference and so many conferences all over the world, because this is a huge industry. 17.5 million guest room, or 17.5 million hotels, 10% of worldwide GDP. Hotels in the US support 1 in 25 jobs and contribute nearly $600 billion to US GDP every year. This is an amazing industry we're in. This is amazing. All right, so hotel industry profile. You can kind of get an idea here of what we're talking about. So it's cyclical, it's capital intensive, labor intensive, maturing, both an operating entity and real estate, higher risk relative to other real estate investments. I heard a little bit of the conversation before. It used to be, I think, a lot riskier. We're going to talk about that, but it's still an amazing industry to be in. All right, what is a hotel investment? You can see here, I'm not going to read it out. It's basically, it's an operating business and real estate. Investment returns come from the operating income and appreciation on sale. All right, sources of equity. Estimates indicate that sources of investment capital are similar to ratios to all real estate investment, with private equity accounting for 75 to 80% and public accounting for 20 to 25%. Samantha, I'm going to start with you. This is pretty basic. Can you give us a little more detail on where the debt and equity for hotel deals comes from?
Sure. So, you think about it, there's essentially the first step of the game is figuring out how much equity you have. So in the equity column, you'll typically look at groups like that have a great deal of cash. And on the previous slide, we saw perhaps individuals, groups of individuals. You often hear people say, I'm going to go to my family and friends to raise the primary portion of my equity. Then there's also all sorts of funds that essentially provide that type of equity, right? So if we're thinking about where do you get equity from, it can be from places like your REITs, right? Like your Sunstone, Braemar, Host, et cetera. And then you can also think about those private equity funds like Blackstone, Pebblebrook, which is also a REIT, PIMCO, Invesco. There's a whole slew of groups that provide equity in order to fund your hotel acquisition. And then you've got to bridge the difference between your actual asset, right, and the equity that you have. So you would look to various forms of debt. Many of those funds that I've mentioned have both equity. They provide equity for a deal, and they either co-sponsor, co-GP, LP, provide some sort of capital leverage to a deal, or they have debt funds. So often you'll look to some of those same groups for debt. Within the debt fund, you'll look to bridge the gap between the amount of equity you have and the total price of the asset. And I know we heard some about, all types of debt, right? You've got SBA debt, agri debt, you've got, mortgage, first lien debt, you've got mezzanine debt. On the equity side, you have different types of equity. You've got co-GP, you've got limited partnership type equity, you've got preferred equity, those types of, all of those put together on either side, put together your entire deal. Just on the debt side, you'll see a lot of folks looking to CMBS. CMBS is essentially non-recourse debt. It takes a lien on your asset. So in the event of some sort of default, it's your asset that's gone and not there's no personal recourse. And on the private side, I would just add here that you can look to what would typically be thought of non-traditional sources of equity or debt. Many of the life insurance companies, pension funds, have, as I mentioned, debt arms that provide various forms of the debts that I just mentioned.
Great. I'm going to pause real quick. We have some seats up front. So for those of you standing, there's a seat on this sofa over here. There's a whole sofa here. Y'all feel free to come on up. No? You guys want to stand? All right, we'll keep going. All right, oh, nope, okay.
Can we go back to that,
Yeah,
that industry profile? Can we go back
Sure.
a few slides?
yeah. You want to talk about it?
Yeah, I do. How many students are in the room? Because I see a lot of people that I've known for a long time who are very sophisticated and well-knowledge. So where are the students?
There's some back there.
Okay, so great. So this slide really encapsulates why hotel investment is the riskiest of all real estate classes when you compare it to office and industrial, and we'll see another slide later on. But I'd just like to spend a minute on here just talking about it, because these 5 things that you see on here is really what segregates us from everybody else. Labor intensive, 30 to 40% more if you're a union hotel of your total revenues is spent on labor, which is very high relative to all the other real estate classes. I'm going to go counterclockwise here. Capital intensive, you can't just build 10 hotel rooms. You have to build all 150 or 200, or in the case of this hotel, all 800 or 900 rooms that are here at one time, irrespective of whether or not you think the demand is going to be there when you first open up. So it's very capital intensive. And then once it's open, you need to be spending money to maintain that asset, reinvesting in it on an annual basis. The ISHC puts out a study, we've been doing it for 30 years now, that says over the life of the asset, you could be spending anywhere between 8 and 10% of your total revenues on an annual basis in terms of reinvestment. We reserve 4%, but typically when you go to renovate your hotel, it requires more equity to invest if you haven't saved up that much money. It's cyclical. We are a discretionary buy for all consumers. So we ebb and flow according to the economy. We typically are the lead in terms of when the economy starts to cycle down. People just cancel their reservations because it's discretionary. They're trying to save money. So that causes some havoc and creates a lot of risk. We can also reset our pricing on a 24-hour basis. We can do it hourly today with the revenue management that we have out there. So the pricing is constantly changing. That could be a great advantage during inflationary time periods, but a disadvantage when demand falls off and you have to lower your pricing. We're both an operating entity and a real estate play here. So we're more an operating entity most of the time. If you hit the cycle right, you may get the real estate play where you're getting a little bump up in value for that. But at the end of the day, if you talk to all of these people in the room that have been around for a long time, it comes down to how much are you generating on the bottom line. That's typically where everybody's going to start to value your hotel. And then if we're in a market where it's costing more to develop versus acquire, you may get a bump in your pricing because of the delta between the two. And then we're a maturing industry, right? The growth that we're seeing is relatively modest. We're not like AI today, which is sort of a hockey stick growth ramp that you're seeing in that industry. We're much more modest in our approach. And so those 5 aspects all together make us a very unique asset within the commercial real estate market.
Thanks, Rick. All right, so we're going to go back to this. So Sam, I'm going to stick with you. You just went through the different types of debt and equity and the different types of owners, basically. Tell us how those types of owners fit in within the full ecosystem.
Sure. So I think on the top you can see we've got a lot of the groups that I had mentioned at first, right? Green money, they often are putting money into the deal, and they're either part of your ownership or part of your debt structure, or both. You've got various types of ways in which you can operate your hotel, right? Branded, independent, self-management. And in some of those instances, we'll see additional types of incentives or equity or key money, as most people know it, brought to the table at some stage in the game. I'd also note that sometimes we see certain types of brand managers put money in on the equity side, so not just key money, but on the actual equity side. And you'll see a lot of third-party managers nowadays also co-owning in some way, shape, or form in the ownership structure as well. Hard brand, soft brand, independent. I'm sure most of you are well aware that there's various types of branding out there. And in each of those instances, the real question comes down to who are they affiliated with? And then ultimately, for an owner, are they putting in money up top or perhaps post-opening as key money? And the asset manager is typically a contracted entity, and your management company, as I spoke to before, could be in your equity or simply a third party managing your asset.
Great, thank you. Did you mention the commonly retained advisors on the side?
I
Because
did
that's
not.
mostly ISHC members, so I like to make sure we call those out.
Thank you. Yeah. So legal, accounting, broker, designers, and other specialists are often and should be retained. I will note the more complicated kind of your green boxes are, the more legal you typically need, more accounting and tax. We are seeing a lot of cross-border transactions at the moment, which requires a lot of tax structuring on the front end. So it's really hard to tax structure after you've already started raising your equity. And because I'm a lawyer and can't help myself, I would strongly advise you to go speak with legal counsel before you start to raise money from friends and family. There is a process to do that. And again, it's really hard to backtrack and mitigate any risk that you might have if you don't do that.
Great. All right, so I'm gonna pause again. We've got more seats up front if anybody wants to sit down, and we're gonna do a quiz, so this would be a good time to come grab a seat if you'd like. All right, how many brands does STR list globally? Over 250? Around 250? Raise your hands. No? Okay, over 500? All right, oh, okay, I see some hands. You guys are awake now. All right, over 1,000. Okay, I see one hand back here. Oh, another hand over there. All right, drum roll. Over 1,000. Good job, guys. So, Jenna, can you give us a high-level summary of why someone would choose a brand? It's expensive, right? So what's the point? Why wouldn't I just open up Andrea's Hotel right here on the corner?
You could.
I could.
You definitely could. Most of the times, the reason somebody chooses a brand is for 3 things in my mind. It's the demand that brands bring. It's the credibility amongst the lender community, investor community.
Oh, sorry. Yeah, maybe get a little closer to your mic. Yeah,
Can you hear me now?
yeah, a little louder.
And then the infrastructure. So on the demand side, obviously the brands have a massive distribution system, loyalty system, global sales organizations that are out there selling their brands worldwide. And so we generally accept that they tend to bring stronger occupancy, higher rates, and are therefore a bit safer. And so lenders and investors love that. So that goes back to the credibility. On the infrastructure side, they bring all these things that if you're an independent, you have to do on your own, such as build standards, brand standards, service standards, design standards. I mean, you get books and books and books of how to build this hotel. So they really do a lot of hand-holding. Yes, it is expensive. You do have to pay for all of this. On average, it's 8 to 12%, sometimes higher, sometimes lower. You can sometimes negotiate. But there are sometimes you don't need a brand. So if you have a smaller room count or you're in a supply-constrained market, it might not be necessary to need one.
Great. All right. When do you not need a brand? Because we love brands, I love brands, we all love brands, but you don't always need one, right? So I'll open it up. When do you not need a brand?
I would say usually when it's a smaller room count and you don't have as many rooms to fill. If you're in a market that has really strong demand and less supply, you might not necessarily need it. If you have a very strong vision and you're an expert at building these systems yourself, you might not need a brand. But it certainly helps with getting a lender on board. They'll probably give more favorable terms, and then investors as well. If they've heard the brand before, they believe in it, they're more willing to give their dollar.
I think another area where you may not need one, and we see it around the country and the world, are destination resorts. Because in some instances, a brand, the difference between brand and independent is typically, if you look out over time, brands will run higher occupancies, but not necessarily higher rates compared to independents that typically run lower occupancy, but in many instances, they can get a higher room rate. So, but the risk factor when you have a brand is mitigated from the lending community and then the equity that you're trying to draw to the project.
Let's do 30 seconds on soft brands. I think, 5-10 years ago, I don't know that I would have understood what that was or known what it was. So why do we have so many more, and what are some pros and cons about soft brands? I'll open it up. Yeah, Clay.
Yeah. Listen, I think the notion of a soft brand has been around for a long, long time. You can look at the Preferred, you can look at the leading hotels, Rallo, Chateau Rallo. It was really when the big brands got into it that it began, I think, to really come to the forefront. But I think, basically the notion is that what we used to want out of a brand, which was consistency and things like that, have become table stakes. That's like assumed. And therefore, people want a more authentic and unique experience. And being able to have soft brands allows you to have sort of the best of both worlds. You have a loyalty program, good reservation system, and still have a hotel that's got its own personality and things like that. And so I think that, generally that's what increasingly the next generation is looking for, is uniqueness in a brand. And in addition, you can sometimes avoid some of the standards that would come with a brand, and you can get a little bit of relaxation from that. So,
I would add to that the uniqueness, the independence were always there. I think the internet was a game changer for the way people were consuming hotel room nights. And so when the internet came and the independents had easier access to get to their markets, the brands took note and saw that people enjoyed those authentic experiences, to what Clay said, and started getting into the business.
So I have this idea, this is totally off topic, to have like Hunter Conference bingo, because a drinking game seems inappropriate. But I think how many times are you guys going to hear the word experience over the next 2 days? Just kind of
authentic
and experience. Just, you'll think of me when you hear it. Do soft brands pay fewer fees, or they just don't have to have the exact TV or the exact whatever? What's the
latter.
The latter?
You're paying
So they pay the same fees? So if I have a Holiday Inn or an Intercontinental or a Signia, I'm going to pay the same if I have an independent.
Well, I think it depends on your distribution, right?
Okay.
Like, so if you're a soft brand associated with Marriott, you're paying the Marriott fees,
Yeah.
right? But if you're a soft brand not associated with one of the big brands,
Okay.
your fees are obviously going to be dependent on that.
So more if it's like preferred or leading, like
Exactly.
Clay was mentioning.
Yeah, and then I think it's really important that to consider when you're putting together, you know, what your hotel is going to be, who your distribution system is going to be. That today, a lot of what we think of as soft brands are affiliated, but not necessarily owned or a franchise with one of the big brands, i.e. Design, right, hotels. So you can book a Design hotels on Marriott's platform, right? But it's not a Marriott franchise agreement. So it's important when you're putting that together that you really understand that as you pitch your equity and your debt.
Yeah.
If I could jump in too, the model tends to be a little bit different if it's a affiliation structure versus a franchise structure. So we're seeing some
So
variability.
I'm going to tell me what an affiliation versus franchise is.
Yeah, so it would be more of a pay-for-play, shorter terms.
Okay.
You know, some of the names that we said earlier, Preferred, for example.
Got
But
it.
you know, we see that brands are teetering a little bit with using and leveraging that structure instead of franchise in some of the cases too. So
Are you referring to like small hotels, your affiliation with them?
that too, and then just seeing how some of the bigger brands are using their collections, and instead of having a typical franchise fee, they're more pay-for-play.
Yeah. I was on the Hyatt website looking for hotels in a specific city, and I saw a lot of the Mr. and Mrs. Smith hotels. Is that an affiliate?
Yep.
Yeah. So those aren't like Hyatt branded hotels, like a Hyatt Place. It's an affiliate. Guys, are
And
you
it
learning
also
as much as I
varies.
am? This is exciting.
It also varies globally, right? So what's in the US is very different than what's.
Yeah, absolutely. Yeah, so actually, in the US, about 70% of the hotels are branded, 30% are unbranded. In the rest of the world, that number is switched. So it's 70% unbranded, 30% branded, although those numbers are starting to, the rest of the world is branding more and more. Okay, we're gonna keep going. Jenna, did you want to talk to this slide?
Yeah, I guess just touching base really quick, speaking about Rick was saying, it's a very dynamic, the lodging industry is very dynamic, and it's evolved even since I've come into the industry. And it's no longer just hotel companies, right? We're hospitality companies. The segments that lodging has moved into, or adjacent segments, has really broadened over the years. So you have, we already talked about collection brands, branded residences, glamping. If somebody told me, you know, we'd be paying $2,500 to stay in a tent, I probably would have laughed at that a few years ago, but that's becoming a very hot segment. Membership in social clubs, wellness, service departments, homes and villas. It's really interesting to see how the industry has expanded. But then also, I was in Miami last week, and seeing how other brands are moving into lodging. So you have a lot of the car companies that are building branded residences, Pagani, for example, Bentley. Fashion companies that are coming in, so Armani, Dolce & Gabbana for branded residences and hotels as well. I think it's fast. I also saw Jean Georges has a residential product, so it's just the evolving industry constantly.
I think your fact here, 70% of brands were launched in the last 10 years.
Amongst these, yeah.
That's mind-blowing.
Do you know what else is interesting is Accor, which isn't even on that list there.
Yeah.
They have the most brands out of all the hotels. I think they're at 50.
Yeah. And I mean, Accor is huge in the rest of the world. You know, the rest of the world, yeah. Okay. So Rick, it's time. Put on your professor hat. Tell us a little bit about the real estate cycle.
So when we were talking about the cyclical nature of the hotel industry previously, this sort of summarizes it. And if we start at the peaks on both sides, that's typically where you're seeing the most new supply entering the market because demand has been increasing and people are reacting to that. Demand and pricing is increasing. If we go to the left-hand side of the market, that's where occupancy starts to decline for whatever reason. It could be a recession. Right now, it's an interesting time right now because of geopolitical and economic events that are occurring out there. If you follow the industry closely, you'll know that most of the prognosticators have indicated that RevPAR may grow between 0 and 2% this year. And if you pull out the World Cup in the States, that number would be negative. And it's mostly coming from ADR and not demand. So demand right now would be on the decline. And pricing typically follows that, because once your demand starts to decline, there's always somebody in your comp set that opts to lower their pricing to protect their market share, and that tends to pull down pricing. So that pushes us towards the bottom of the V. And I would say, I mean, I'd love to see a show of hands where everybody thinks we are in this cycle right now. It is an interesting time. We could be on the left-hand side towards the bottom. We could be a little on the right-hand side. We could be squarely in the middle. Time typically tells, and you're not sure until after it happens. But once you hit the nadir, that's where your maximum financial opportunity is if you're buying into the industry, either on an acquisition or a new development, because the upside is sitting in front of you, and you have time to gain traction and make money. And that's characterized as occupancy and demand increases. And once that happens, then you're starting to push pricing up. Once you do that and it becomes more economical to build new supply, then you start to see an onslaught of new supply. We haven't seen that since COVID. I mean, over the long term, Clay probably has better stats than I do, but over the long term, supply typically increases at a 2% annual rate. Since COVID, we've been below 1. I think it's approaching 1% right now, so we are definitely below what the long-term trend is, so that gives you an indication of where we are in the cycle.
Just one comment to what Rick was saying. I think paradoxically, that point of maximum financial opportunity is usually when there's the least amount of equity and debt capital available.
Yep. And that's the most amount of risk too, right? Or sorry, say that again?
That when you're down at the maximum financial opportunity, usually at that point, all the debt capital, a lot of the equity capital has pulled back, and it's very difficult to get the money to actually execute on that. So
And
those
that's
that
because
have
there's
capital,
more risk, right? Because there's more risk in the
Perceived
market.
risk.
Perceived
risk, exactly.
Ooh, I like that.
So
All right, so we should all start collecting our pennies and saving so we can have some equity then? All right. But you know, it's interesting because I go to a lot of conferences and have for many years, we won't say how many, and I've sat in these sessions and the general sessions, and somebody will say, we're at the bottom, we're at the trough, we're there. And then I go to book a hotel and I think, well, I'm gonna get a great deal in the Caribbean maybe. I'm gonna get a great deal in Europe maybe. And I'm not getting a deal. And I guess what I'd like to talk about is how this is not for the whole world or even the whole country. It can be market by market, right?
Absolutely.
Yeah.
Absolutely. I mean, depending on where you are in the market, New York is having a relatively good season right now because of other things, the reduction in Airbnb, which proliferated there, and then they put a law in that you couldn't do that anymore. So hotels, and at the same time, there was a reduction in hotel supply up there because of other reasons where they were being converted to residential. So you had a reduction in supply. They took the shadow supply off the market, and New York took off from a hotel perspective.
So it's not just economics, or it's not just like politics and the geopolitical stuff you were talking about. There's a lot of factors that can go into this.
irrespective of the macro environment, I probably would underscore best, look at Portland versus West Palm Beach. Okay, they have the same macro environment, but if you look at the local environment, I mean, Portland is down at the bottom, and West Palm Beach is seeing numbers they've never seen before.
For lots of different reasons.
Lots of different reasons.
Okay. We're going to pause real quick and take questions. And I know this is kind of a large room and lots of bright lights for questions, but if you've got one, I'd love for you to raise your hand and I'll call on you. No questions? Nothing? No students? Am I
Like
missing
a
one?
typical classroom.
All right. That just means you guys are that good at what you're doing. And they're so excited to hear more. Okay.
Oh, I have one.
Yeah. Oh, we have one? Oh, I see you.
So I look at the B, and ADR improves, occupancy improves, supply picks up. Being a small developer, this time seems a little bit different in terms of just the input construction cost. Talking about Florida, it is very, very expensive to build in Florida. And then on top of that, you put in capital markets that require more equity, even with rates less
Yeah. So let me repeat that so when you look at kind of the V and when it's going up, ADR improves, margin improves, and development picks up. What this gentleman was saying is that with construction costs the way they are and everything else, all the headwinds towards development, is this still what it's going to look like? Or, are there two different shapes now, one for occupancy and ADR and one for development?
I mean, I personally believe that ultimately this is the shape that it's going to look like. It's just going to take longer until the rates and occupancy get to the point where it's going to justify arguably a different cost to develop now. But eventually it'll get to the point where the bottom line replacement costs end up, basically values exceed replacement costs and people will start building again. It just may take longer because without doubt, interest rates, and construction costs, things like that, are making it a lot more expensive. So deals don't pencil until you get way up there on the profitability line.
And I think COVID upset a lot of what we traditionally knew. I mean, for instance, the supply chain, the cost of construction has gone up 40% since COVID cumulatively over time, which has made it incredibly expensive to build right now, which is why acquiring existing is cheaper than building on top of the debt and the cost of debt and equity. So it's going to take a while for all of that to work out in the system.
Great. All right, quick pause for the AV team in the back. The clock here says 9 minutes, and I've got 30 minutes left. We can take 30 minutes, right? Okay, we're going to keep going. All right, so Clay, help us understand what a cap rate is and how it's used. And I think these slides may be a little out of order. If we want to do this one first.
Okay, all right. I'm going to step back just a second because I mentioned I'm a professor of real estate, hospitality real estate now. I've only been doing that about 3.5 years, and I'm not sure whether I've learned more or taught more. But in the process of doing that, I've learned there's a lot of assuming going on that just isn't so. And one of the things I've learned that there is an awful lot of people, whether they're students or whether they're in the operations side of hospitality or even in the ancillary design and construction, architecture and things like that, that truly don't understand at a fundamental level that value is tied to income. They may be reticent to admit that, but there's a lot of people that don't understand that fundamental, that fundamental fact. And so that brings us directly to, well, if value is tied to income, then how? And it's basically tied through cap rates and discount rates. And there's a lot of confusion around how do you get to a discount rate? And so what I hope to try to do a little bit is demystify that just a little bit by saying, it's basically everyone starts at the same place of a risk-free rate. And then on top of that, you have to add to account for risk. There's operating risk and there's liquidity risk. And so the operating risk, people, well, what is that? Well, is it a complex building? Is it going to require a lot of improvements to turn the operations around? Is it operationally complex? As you're thinking about how to build up what your discount rate is, think about, do I have a lot of experience in operating or not? Those types of things. So these are all things that would add to the premium of your discount rate. And then on the other side, because I'm trying to bring it to a common sense level, on the other side is the liquidity risk, which is basically how quick can I turn this into cash if I have to? And so, for example, if you're a sovereign wealth fund, and maybe your investment thesis calls for an exit in 5 years, but if you don't really care, well, liquidity risk is not that big of a deal to you. But if you're a private equity fund and your investment thesis says, hey man, we got to exit here in 5 years, liquidity and the ability to sell when the time comes to sell is very, very important. So you would add to that. And when you add those three components, everyone starts at the same place, and then depending on where your perception of operating risk and your perception and your importance of liquidity, you end up with what your discount rate is. And that's how two people, different backgrounds or whatever, can look at exactly the same numbers and come up with different values. That's basically what goes into that. And then cap rates are directly related to your discount rate. It's just basically your discount rate less your long-term growth rate, and that's basically your cap rate. One last important thing about cap rates, because a lot of people don't really understand this either. Cap rate only works if the assumption is that the operation is stabilized. It has to be stabilized, either when you buy it or when you exit. The assumption is it's stabilized operations. In all other cases, you have to do a discounted cash flow analysis using a discount rate. I hope that clarified. Again, we have a lot of people who know this by like the back of their hands, but there's a lot of people who don't fully understand the relationship between that. I hope I clarified it a little bit.
I think the one thing I would add to it is that cap rates are also inversely related to the direction of the economy. So as the economy is declining, cap rates are increasing because there's a perceived additional risk occurring. So people are going to want more return in order to invest in that point. And the opposite is true when the economy is improving, cap rates tend to come down.
Great.
As do discount rates.
Let's
Same
do
trend.
discount rates. Okay. So Rick, talk us through let's bring some of this together in different real estate classes, cycles, cap rates. What's this?
A lot of spaghetti lines.
Yeah,
but
what is all this?
if you remember what we were talking about, the industry profile, this is how it manifests itself in the investor community when they go out and they're making a decision as to whether or not they're going to purchase an office building, industrial, multifamily, or hotel. You can see that hotel is the top line up there, and traditionally, as long as I've been in the industry and even before that, hotels have always required a higher rate of return in order to entice equity to come in and participate in that investment relative to all the other asset classes for the reasons that we've already talked about. And you can see it's typically, it depends on where we are in the cycle. GFC is the great financial crisis that we suffered in 08 or 09, where the differential was quite large relative to the other asset classes. And think about it this way. Industrial, you're leasing out that building for multi-years. Multifamily, you have an annual lease typically with whoever your renter is. Office buildings used to be 10-year leases. So when COVID happened, right, in the hotel industry, revenue went down to zero or close to zero, depending on what hotel you owned at the time. Office buildings, they continued to get paid. Industrial continued to get paid. Multifamily continued to get paid. So that sort of explains why we are perceived as the higher risk factor here. The only other thing I want to note here is that you'll notice that office used to be one of the preferred commercial real estate investments, but you can see post-COVID how those returns, they required higher returns over time because of what's going on with office space, with people not returning to the office, working virtually and so on, and office buildings are now empty, and you can see how the markets reacted to that. So this is a great slide to just tie back to that industry profile of hotels.
He created this slide. He wants to get credit for it. It's a very good slide, Rick. Thank you. No, I'm just kidding. All right, we're going to pause again for questions. No? You guys are so quiet.
Can I make another,
Please. Yeah.
perhaps controversial point a little bit? You know, a lot of the things that Rick mentioned, the two main things that have always been perceived as like the weakness of the hospitality industry, you know, is sort of the short-term leases. In fact, you got 18-hour leases basically, and the operations-intensive nature of the business itself is also one of the reasons why I believe, and some evidence behind it, that it's becoming a preferred investment class for like smart equity money. Because of those two things, it's one of the few commercial asset classes where you can really come in and have an investment thesis and create value. You know, if you're buying an office building or industrial, whatever, and chances are it's going to be backed by long-term leases, there's not a whole lot you can do to impact value. But if you see an opportunity in a hotel that is not well run, it's not well positioned, it's not well branded, whatever, you can actually go in and say, I'm going to put a brand on this, I'm going to get a new general manager, I'm going to put in capital in this particular place, and immediately impact value and actually move that needle quite substantially and turn around and sell it in 2 or 3 years. And so I think particularly, you look at a lot of equity going over into Europe and seeing exactly that opportunity, because supply is very difficult to add new supply, but there's a lot of undercapitalized and not so well-run assets there that smart people can go in and So that combined with strong macro fundamentals that are driving more and more people to travel is I think why a lot of people are diving into this space.
It's like flipping houses on steroids.
Yeah, in a way.
All right, so we kind of skipped over
Building
this slide.
platform.
Yeah, but I love this. There's a lot of wonderful things about our industry, and I think for the students in the room or younger people, you're gonna at some point see a major downturn. And it's, oh my gosh, the world is ending. Will hotels ever recover? How many times have you guys heard that in your careers?
More than I'd like to say.
More than you'd like to say. So I love this slide because it always comes back. What goes up must come down. And Clay, you touched on this at the end, that people, we saw this at COVID. Travel is not, it is discretionary, it is whatever, but it's not a want, it's a need. And so we do come back. I don't know, this is just like my warm and fuzzy about hospitality, and I love this slide. Anybody want to comment on?
But this is the V. Remember, we were looking at the cyclical nature of the industry. So this shows you over time
Exactly.
when those cycles occurred. And the most dramatic one, obviously, is COVID.
Yep.
But you saw the bounce back that we got in a post-COVID world.
Yeah, that's right. So this is the slide Rick talked to. So this is kind of the textbook picture, and this is the reality. This is what it actually is like.
This could also apply to a hotel, an individual hotel. Samantha and I are working on a project where the one off to the right there is probably going to experience that if it finally renovates. But this is typically reinvestment in hotel, raising it, and then it gets tired again, or changes management, or the market turns on it, or whatever, and then it comes back.
Yeah.
And I'll also note that the way in which hotels are being built or the way the pipeline is coming to be is changing, often by market, but it's really changing. So like in Florida, where this probably doesn't look exactly the same, it's almost more extreme. Almost every hotel other than, a couple convention center hotels are going up with branded residential. Branded residential functionally mitigates, and deleverages the risk associated with any construction. And another thing I've seen over the course of the last decade, I remember being on phone calls where all we would have is conversations about how to make the hotel bigger, right? To go from 120 rooms to 130, 250. There was a lot of talk about we need to maximize that particular space to make the hotels bigger. Now see the flip, especially in markets like Florida, abroad, et cetera, Texas, where we're having the opposite conversation, right? We're saying, okay, let me sell more residential units, whether it's condo, hotel, or transient units, and smaller hotels. I mean, those are a lot of the conversations we're having. Rarely used to see 20, 30, 40, 50, 60, 70 key hotels, and now we're seeing them all the time because they're delevered by, some branded residential or a dual hotel strategy to diversify the risk, like, ultra luxury projects surrounded by just like a more 4-star project in order to lure a lot of those guests in.
Great. So what I want to talk to, and actually, Clay, I wish I wasn't jumping around because what you said last really leads us nicely into this. So if you're looking for a deal, and I'm going to, should I start with Jenna? Are you okay? You want to wait a second? We'll wait a second. Okay. What to look for in a deal. So you mentioned a couple things, right? Are there improvements to be made? Is there a brand? Is it encumbered or unencumbered? Let's talk a little bit about what that means, and I'll open this up to everyone. Is when you have a deal, what makes it positive or negative? What makes you say, this is my deal, I'm gonna do this, or nope, walk away? Kind of your top 5.
Well, to me, that's one of the exciting things when I talk to my students, they say, oh, real estate is boring, the numbers. No, what I find so fascinating about it is the sky is the limit in terms of the creativity that can be brought to add value, to the right real estate product. But, I would say, this location, and not only is it just the physical location of the asset itself, it's location within a market that for whatever reason has relatively high barriers to entry to the investment that you're thinking about making. And of course, it depends within that particular market. Where is it within that cycle in terms of basic fundamental operating performance? The capital market, the structure of your capital has to make sense as well in terms of, are you able to get at a reasonable level, low cost, long-term debt? And do you clearly have a thesis for what you're going to do, what's the time frame to implement it, how it's going to be implemented, and more importantly, how are you going to exit? So I think those are like the 5 main things that I would look at in looking at a deal, whether I'm buying it or building it.
Okay.
Buying it, obviously, a little easier.
Yeah.
I think I'm back.
We've all been there. We've all been there, yeah.
I'll jump in and just share how brands look at and evaluate each deal. A mentor once told me we look at it 4 ways: the box, the location, the sponsor, and the deal that the brand is making with
What's the sponsor?
the owner.
Okay, the owner, okay.
So the box, spending a little time on that. There are good bones, there are bad bones. There's good maintenance, there's bad maintenance. So when we tour hotels, I always go into the least favorable place in a hotel, which is usually the HVAC or mechanical room, and see what that looks like. Touring the back of house, I've seen hotels that have insulation hanging from the roof and tiles missing, and if that's what it looks like behind, in the back of house, makes me a little bit nervous, but it informs you of what the capital needs are beyond the cosmetic needs. On the location, obviously market is important, but so is the micro location. For luxury, I feel like luxury is such an anomaly. You always want a different location for luxury than you want for everything else. Lifestyle is that way too, right? So there's this concept of destination making, and will people come if you build something really cool that requires them going out of their way? Does the location fit the brand, and who's traveling into that market? The sponsor is important too because, there are a lot of successful people out there, but that doesn't mean you're going to be a great hotel developer or owner. And so it's my kind of golden rule is if the person surrounds themselves with the right working specialists and group, the right designers, architects, consultants, attorneys, they can make magic happen, right? So the worst thing I can imagine is somebody who thinks that they can come in because they've built other types of real estate and say, we're going to build a hotel, and it's like, whoa. Take a deep breath. They're very complex, as we've heard today. And then the deal, brands look at what is the NPV of the fee stream that is coming to.
Say that again?
What is the net present value of the fee stream that's coming in from this hotel, but then also how strategic is this brand for this market, right? So there might be, maybe that brand is underrepresented in the market and they want rooms, or their loyalty members or their group sales teams know that they have business that wants a luxury hotel or an upper upscale hotel in that market, which may mean that they value that particular deal and brand in that market even more.
NPV. Guys, I'm learning a lot today. I hope you are too. This is really exciting.
Just to sort of raise what all of these guys have said up to the level, there's really, when you come to make a deal, invest in hotels, there's market risk, financial risk, and management risk. And what you're trying to do is mitigate all of those with who you're bringing on, branding, consultants, whoever it is, the private equity, the sponsor, all of that. Market risk is branding, it's location, it's everything to do with the market, who's in there, is there white space, are you coming in, or you're just duplicating what somebody else has. Financial is debt and equity. How are you going out to finance this? What are the fundamentals of that? What is the return that you're looking at based on the pro forma that somebody's generated for you? And then there's management risk. And in hotels, management is critically important. We asset manage a lot of hotels. I've been doing this a long time. If you don't have the right management company for the right box that you're investing in, you typically experience lower expectations across the board. And then even beyond that, the importance of who your general manager is at the hotel is critically important, and every owner should have an approval right over who the management company is hiring to put in that hotel as their GM.
So, okay, so we've talked about brand and management and that type of thing. If I'm buying a hotel, can I pick my own people? What are I'm talking about like encumbered and unencumbered hotels. Like, what are the things I would think I'm the boss? I'm gonna come in and make it all mine.
So we've all worked together
Yeah.
before on
Yeah.
deals. So I'm sure Sam, as a lawyer, can walk you through all of the places in a hotel management agreement where you're giving control of that hotel to the operator of that hotel, and that's through an agreement that they present to you. And then the owner goes through there and tries to exert its influence on that property. But at the end of the day, once that management agreement is signed, the owner has approval rights and certain rights for input into that process. But they're counting on that operator to execute according to the terms of the agreement.
Yeah, I mean, simply put, it's a contractual arrangement, but in branded, managed hotels, generally speaking, you should consult your lawyer, but generally speaking, the management agreement goes with the asset. Think of it as, encumbering just the way a CC&R or anything else would encumber the real estate. It goes
What's a CC?
covenants and restrictions. It actually sits with the land and goes with the hotel. And a franchise agreement, it's a contractual relationship between the owner of the hotel and the brand. You need to consider when you're selling your asset or buying the asset whether that franchise agreement needs to exist or a subsequent franchise agreement needs to exist with your subsequent buyer. But a management agreement, like a third-party management agreement, is purely contractual. So you have to consult your management agreement and see whether you have a right to terminate the management agreement upon a sale of the hotel. And that's a lot of what a buyer of an asset would do, is understand what goes with the hotel upon sale, upon purchase, and what can be terminated or not, and how much it costs potentially to do so.
How long do those agreements usually last? So if I own a hotel, I sign a deal with a management company, and it states that it's going to last this long, whether I sell the property or not. Is there a standard?
So a branded management agreement can be anywhere from 15 to 80 plus years.
Holy.
At the luxury level, they're typically much longer.
Yeah, ultra luxury, they're usually much longer. Franchise agreements are typically 10, 15, or 20. That includes membership agreements. Third-party management agreements, nowadays, today's market are anywhere from a couple years to 10, 12 years.
Wow.
They can be longer and they can be shorter, just depending on the circumstance.
I mean, that's longer than most marriages, right? Like,
Comment, yeah.
you may want to leave me, friend, but you're stuck. All right, so we've gone through the deal. We've found the one we want. It's a new build. We're super excited about it. All the fundamentals check out. Talk us through, Sam and Clay, a little bit about how the money could work. And one of you can take a new build, one of you could take and acquire an existing, but how do you start putting all this together for different types of deals?
Sure. So I guess I'll take the building a new hotel.
Okay.
So again, in this environment, generally it's a feat, right? So you've got to undertake first. You've got to understand, what you can build. So you've got to understand your land, your entitlements, meaning what can you build, how high, how wide, what's next to you. And you likely have to understand what that market can generally afford. So are you building a courtyard or are you building an Ononterra, right? Like there are different costs associated, obviously, with building either. And so you've got to understand what your total project cost is likely to be, which is why you hire hotel consultants and whatnot to help you price that out and pick the right brand. The market today, generally, you're looking at debt somewhere between 50% and on the higher side, 70. We do see higher, 75, 80, but most lenders start to shy away once you get past that 70 loan to value or loan to construction cost threshold. So, you might be able to look at debt for your total project costs. And by the way, your total project cost should include your pre-opening and, perhaps the first year of operations, because you're definitely not going to be stabilized in the first year. So 60 to 70%, and then you're really building the remainder of your equity, right? What do you need in order to do that? I will just say that often it happens in reverse. You've got to show that you can get equity, right? That the market is receptive to the project, and then you build in debt. It's rarer that debt comes first, and then you're filling out equity. It's most common you have most of your equity, then you go get debt, and then you have to go plug in additional equity.
Got it.
And then I would say, looking at the acquire the existing asset, I would almost rearrange this a little bit where I'd put the debt on the bottom and the mezzanine above that and the equity at the very top. Okay. Just kind of thinking that, when you're looking at your senior debt, I think one of the most important things is just to understand the principal difference between the debt and the equity side is the debt actually has a legal contract. There's a loan agreement where you are legally obligated to pay back that loan under the terms and whatnot of the loan agreement. And therefore, lenders have a different mentality, and it's all about downside. They're just kind of, negative by virtue of their nature. And so they don't participate. The hotel can be an absolute home run, but it doesn't matter to the lender. All they're worried about is contractually, pay back, what's the worst case scenario if I have to take this hotel back, et cetera. And then the thinking in the mezzanine, 9 times that, most cases, that also, it's a contractual arrangement of what they're gonna, some mezzanine takes much more of a debt character, other becomes a little bit almost quasi-equity.
Sorry, can I interrupt? What is mezzanine debt again?
Well, think of it as like a department store, the main goods are there on the ground floor, and then they would put sort of the stuff that didn't sell so well, a little bit riskier, you need to really want it in order to go up there on the mezzanine and get it. So the mezzanine is kind of the piece that there may be a gap between what the senior lender is willing to give you and how much equity that you're able to raise, and so it's gonna cost you more.
Okay.
But you basically can get these people that are going to go in and say, look, I will fill that gap for you, but it's going to cost a little bit more. And usually it's also contractually, but they have arrangements where they can get both a contractual ability to be paid and in one way or another participate in the upside of the project. And then lastly, the mentality of the equity, they have a theoretically indefinite upside. And so, but they have all the risk. They're the last ones to get paid. Everyone else gets paid first. And so, that's why equity tends to be the most expensive of the capital. If things go really well, you can make very, very good returns. If not, yours is the first to be wiped out.
And I'll just add that on the building the new hotel versus acquiring an existing hotel, on the debt side, it's usually way more expensive, right? Because there's the obligation to actually construct the asset. So if the lender has to realize its ultimate remedies and foreclose on the asset in a senior loan construct, what does it have? It doesn't even have a business at this point. It literally has perhaps just a hole in the ground or, some steel pillars up. So that debt on building a new hotel is pretty expensive.
So
it's at a higher rate.
Yes.
Okay.
yeah, and Sam, Jenna, and I, it's a Hilton hotel. We're working on a project right now that's under renovation. It was a private equity individual that purchased an existing hotel, an older, tired hotel.
Okay.
And he bought it for, roundly 20 million, and he's going to put another 20 million into it. And he's converting it from, it was a large hotel, 250 rooms, and he's converting it to a dual brand hotel. So he's going to create 2 products in the same building. We got a PIP from Hilton to do that. And he went out and he got a regional lender to provide him the debt. But to what they were saying, his equity, and it was probably about 60%, but his equity he's got to exhaust all his equity investing before the debt is going to come in to build that. So it is open and operating, so that's the benefit of acquiring an existing hotel. You don't have to sit there and have all that money go out and then wait for the cash to come back in. it's not coming in at the level that it will once it's
Yeah.
renovated. But
Okay.
so
All right, the light is flashing. Thank you all. We can, you know what, I'm gonna take one question. No? All right, great. Please
Somebody
join
has
me.
a question.
Oh, wait, we do have a question. Oh, yeah. Thank you.
You guys spoke about hotels. Can you lean into what the forecast or demand is for conference convention centers? And then does it mirror exactly what what you're seeing in the hotel space?
Yeah.
actually, the group market relative to conventions has been rather robust over the past 2 years and continues to be. I think the last stats I saw were last week's, that group demand and group RevPAR is up at not a double-digit rate, but a pretty solid single growth rate relative to what the other segments are doing.
Great.
Yeah, I think that the combination of there having been a lot of pent-up demand for the need to get together face-to-face is driving a lot of that group business. That in conjunction with the fact that to build a new, whether it's a new convention center or a new group hotel, is very, very expensive. It is one of the strongest barrier to new supply, and I think that's also driving the performance of group hotels today and probably into the near future.
Great. Please join me in thanking our panelists, and thank you all for being here.
No, it's going up.